Hi, I'm Andrew K. Wallace. Imagine it's a Tuesday morning in 2026. You're walking through the financial district of a major city, London, Chicago. It almost doesn't matter which one. The streets are clean, the lights are on. But when you look up, floor after floor of glass offices are dark. Not because it's early, because no one works there anymore. Inside the buildings, security desks are staffed, elevators still run, but the offices themselves are empty. Entire towers operating at 20% occupancy, if that. At the same time, somewhere else, far from the street, a credit committee is staring at a dashboard. Loan-to-value ratios flashing red, refinancing deadlines rolling closer, appraisals quietly revised downward. No alarms, just numbers moving in the wrong direction. This is the commercial real estate crisis, and it's already here. Most people think of real estate as slow, stable, and boring, especially office buildings. Long leases, blue-chip tenants, predictable cash flow. That assumption made sense for decades. It doesn't anymore. The structural foundations that supported office valuations have shifted, and they aren't coming back. Remote work wasn't a temporary shock. It was a permanent demand reset. Once companies learned they could operate with fewer desks, fewer floors, fewer headquarters, the incentive changed. Office space went from asset to liability. And incentives always win. Here's the quiet part. Office buildings are not just buildings. They are collateral. They sit on bank balance sheets. They back pension funds. They support insurance reserves. When their value drops, it doesn't stay contained. It travels. In cities like London and Chicago, office valuations are down 30, 40, sometimes 50% from their peak, in some cases more. But the losses haven't been fully recognized. Not because anyone is lying. Because recognizing them all at once would trigger consequences no one wants to deal with yet. Banks don't mark assets to reality when reality is destabilizing. They smooth, they extend, they pretend time will fix what incentives broke. Ask yourself a simple question. If you were a major lender holding billions in commercial mortgages, would you rather acknowledge massive losses today or restructure quietly and hope conditions improve? Again, not a moral question, a survival one. So loans get extended, maturities pushed out, terms adjusted. This is called extend and pretend, and it's not new. What's new is the scale. The problem isn't a few bad buildings. It's entire portfolios, entire districts, entire business models built around daily foot traffic that never returned. Coffee shops closed, retail hollowed out, transit revenue down, city tax bases eroding quietly. This is where ordinary life starts to intersect with the crisis. Cities rely on commercial property taxes to fund services. When valuations drop, revenue follows. But expenses don't, so fees rise elsewhere. Transit fares, permits, utility costs, small changes, spread out, barely noticeable at first. Meanwhile, banks tighten credit. Not dramatically, just enough. A mortgage approval takes longer. A small business line of credit gets reduced. Interest margins widen slightly. You feel it, but you don't connect it to an empty tower 10 blocks away. That's how systemic risk works. It doesn't announce itself, it diffuses. There's a pivot point in this story, and we're approaching it. Commercial real estate loans don't last forever. They refinance every 5 to 10 years. Many of the loans written during peak valuations are now coming due. Refinancing at current prices doesn't work. The math breaks. If a building is worth 40% less, the borrower needs to inject new equity. Most can't. So defaults rise. Not because of bad management, because the asset no longer supports the debt. This reframes another outdated belief, that real estate always recovers. Location, location, location. That mantra assumed demand was permanent. It wasn't. It was structural to a specific way of working, and that structure collapsed. Converting offices to housing sounds like an easy fix. It isn't. Zoning issues, floor plate design, plumbing, costs that often exceed the building's remaining value. Again, the math doesn't work. Smart money sees this clearly. That's why large institutions are writing down exposure quietly, selling at discounts, offloading risk to less visible vehicles, not panic selling, positioning. And here's where the comparison to 2008 matters. The last crisis was about leverage on homes people lived in. This one is about leverage on buildings people don't need. That makes the political response harder. There's no homeowner narrative, no obvious villain. So the losses sit, deferred, distributed across the system. Watch how banks talk about it. They'll say exposure is manageable, well-capitalized, isolated. Those words aren't lies, they're framing devices. What they don't say is that everyone is exposed to everyone else through shared funding markets, shared insurers, shared confidence. Confidence is the real asset here. At some point, confidence compresses. It doesn't vanish, it tightens. Lending standards harden. Capital becomes more selective. Projects that made sense 5 years ago don't clear today's hurdle rates. That's the structural limit. When refinancing stops being routine and starts being discretionary. When optionality disappears for borrowers, not because of regulation, but because capital has better places to go. And capital always goes where it's treated best. This is why you see money flowing into data centers, energy infrastructure, logistics hubs. Assets aligned with how the world actually operates now. Offices aren't aligned, they're legacy. But legacy assets don't vanish quietly. They decay. And as they decay, they pull on everything connected to them. Banks, cities, pension funds, insurance pools. The public narrative will lag. It always does. By the time it catches up, the repricing is largely complete. This isn't about a crash. It's about erosion. Slow, relentless, and difficult to reverse. The people most exposed won't be the ones who built the towers. They already extracted value. It will be the ones who assumed stability, that the old demand would return, that time alone would heal the balance sheet. Time doesn't fix broken incentives. The empty skyscrapers aren't a temporary anomaly. They're a signal, a visible symptom of a deeper realignment between how capital was allocated and how the economy now functions. And once you understand that, the silence around this crisis makes sense. Talking about it doesn't help anyone in power. Managing it quietly does. So as you walk through those empty corridors, or past those darkened floors, understand what you're really seeing. Not failure, transition. Capital withdrawing from a model that no longer justifies its footprint. Power doesn't collapse loudly. It reassigns itself. And for those who aren't prepared, the realization comes late, when the credit tightens, the costs rise, and the familiar structures they relied on quietly stop supporting them.